Jason, one of the things I'd like to, first talk to you about is because obviously based on a lot of the videos that I've seen of yours, you've got a pretty strong sentiment that, you believe that the housing market's not going to crash and doom and gloom like a lot of these other YouTubers and influencers are saying. And you put out a video recently, which, by the way, for those guys listening and watching, please go check out Jason's stuff. Jason's channel is probably one of the channels I check out regularly to get my information. And so usually when I'm working out, I've got Jason's voice, and talking to me while I'm doing bicep curls, right? But you put a video out recently, man, talking about and debunking kind of the myth of a housing shortage, right? And I just thought that was really neat. And you shared some really cool data. Talk to us, just to kind of begin this episode here. Talk to us a little bit about that, because I think that's one of the kind of the cornerstones that a lot of the doom and gloomers on YouTube are saying. There's going to be massive amounts of inventory and all this stuff. So share with us your perspective.
Yeah. Well, I'm not debunking a housing shortage. I believe there is a housing shortage.
Correct. That's what I meant. Sorry.
Yeah. And I believe it's pretty severe. We have a pretty darn severe housing shortage. And the government, as usual in their infinite wisdom, is incentivizing all the wrong behaviors. It seems like, and I'll just mention this and then we'll move on to the specifics, but it seems like every program intended to help with the housing affordability problem is a program designed to help buyers buy a home. And essentially, what does that mean? That increases demand. We don't need to increase demand. We need to increase supply. And so what they ought to be doing is helping builders build homes. But of course, then we get into the NIMBY problem, which means not in my backyard. We get into the environmental problem and, all of that type of stuff. So these are complex issues. And the interesting thing that's kind of related to this, Daniel, is that governments around the world always want to protect asset prices because they know, and the central banks that they're affiliated with know, that one of the worst economic maladies you can ever have is asset price deflation. Okay, now deflation to most people means prices going down. And most consumers would say, well, isn't that a good thing, Jason? No, it's actually not a good thing. There's a difference, though, between consumer prices and asset prices. And essentially the way the wealth effect works is when asset prices go up, consumers convert the value of those assets to buy consumer goods, okay? And that, of course, stimulates the economy. In the United States, about 70% of the S&P 500 is consumer spending, okay? So it's a huge deal. And if we don't have the wealth effect of consumer prices increasing, of asset prices increasing, then you don't get the consumer spending and you go into this downward spiral of a deflationary spiral. And why deflation is so dangerous to an economy, it is literally the worst economic malady, is because when you have deflation, there is no urgency to spend. And when you have no urgency to spend because people think in the future prices will be lower, they stop spending. And it contributes to this very negative self-perpetuating cycle that is very hard to get out of. The opposite of deflation is inflation. And that's been the trend for a long time. And I think it'll continue to be the trend. So when we look at housing, to kind of circle back to your question, sorry about the tangent.
No, that was good.
When we circle back to that, they always want to prop up asset prices, especially housing, but also stocks and bonds and so forth, right? But housing is one of the key assets and one of the key wealth creators in America and around the world. So there is a very significant housing shortage. It's unlikely to be solved anytime soon. I think it will persist for maybe decades to come. As I've talked about a lot before on your show, the Fed, in their massive easing policy that we had during the COVID era, where we saw some of the lowest interest rates ever, they put a poison pill into the real estate market where people could obtain these 3-decade-long mortgages at historically low rates And now we're in the position where people don't want to part with those cheap mortgages because, Daniel, they have too good a deal. So this has created what's referred to as a lock-in effect. They don't want to give up the cheap mortgages. They, most people think, and I've been saying this for 20 years, so it's not a new statement, but most people consider the house to be the asset and the mortgage against the house to be the liability. Well, I've always said the mortgage is an asset, and especially when that mortgage is a below-rate mortgage. If you think about how anything in the world, how value of anything is determined, it's determined by two components, scarcity and utility. And money, just like everything else, like gold, diamonds, cars, houses, whatever, that's an asset class. Money, the cost of money. So if you have a cheap mortgage that is 1/3 or 1/2 the price of any money you could obtain now, and your mortgage is under that rate, then that's an asset that is more valuable to you, and you don't want to give it up. And so that's why we're going to have a housing shortage for a very long time. That's the most likely scenario. And think about it. These people with these cheap mortgages have 27 to 28 years left.
Yeah.
Wow, poison pill. Okay, now it's not a poison pill. I call it a poison pill, but it's not a poison pill if you have one of them or if you have a whole bunch of them, like our clients do and I do, right? That's a really good deal. But for the ability of the real estate market to create inventory and supply housing for the people who need housing, it's a poison pill.
Yeah, and it's so fundamental, right? Because it's, hey, if there's low supply and there's very high demand, prices really aren't going to plummet anytime soon, right? And one of the things that I heard you mention on your show recently is you brought up a very strong statistic. You brought up the idea to contribute to what you were saying that, when you have the cost of your debt, when, your interest rate on your mortgage is lower than inflation, I mean, man, what a tremendous asset that is, right? So that's number one that I want to kind of bring up to add what you were saying. But number two, you brought up the statistic on your show the other day where, I think we have about 42% of people that have no mortgage, that their house is more so just completely paid off and is absolutely an asset. And that's so opposite to what we experienced 15 years ago, 15, 16 years ago.
Yeah, no, you're absolutely right. So 42% of the homes in America have no mortgage at all. So when we think about, will there be more inventory? Will there be, look, I mean, if you want to have a real estate crash, you must have one ingredient, absolutely required ingredient. You cannot have a real estate crash without this ingredient. And that ingredient is millions of distressed owners who become millions of distressed sellers, dumping their properties on the market. But now we have the opposite of that. 25% of all the mortgages in the country are at or below 3%. 65% of the mortgages in the country are at or below 4%. And 42% of the homes in the country have no mortgage at all. So how do those people ever get into distress where they become motivated, desperate sellers? The answer is they don't.
Yeah.
And that's why we're not going to see any tidal wave of inventory. And Daniel, people have, as I've been the contrarian, and so many people have been publishing all of these videos on YouTube or articles in the press or blog posts or whatever, saying the market's going to crash, the market's going to crash. I have been trolled relentlessly on this. Nasty comments on my YouTube channel when I do interviews on other people's channel. And, they say things like, well, Hartman is just talking his own book. Hartman is saying this, but this interview won't age well. And listen, they've been saying that for over a decade. Okay. So It's aging pretty well. And certainly since 2019, certainly during the COVID era, people were saying that. And all along, I'm just looking at the data, folks. There's just no data to support a big crash. So here's one of the things that people have come up more recently. They say, well, Jason, you're going to be eating your foot. You're going to be eating your words. You're going to be eating your hat. Okay. when the mass layoffs come. And now in the past year or so, we've certainly seen some layoffs, and we're in layoff season right now. Companies are tightening their belt. But what I did, and I can show you the screenshots of this if you want, and I thought about that, and I said, well, look, the way people got this whole thing wrong is this. There's about 140 million housing units in the United States. And since we had the massive rate hikes, the most incredible, ridiculous, and absurd interest rate hikes in history ever, right? Where the cost of mortgages, the cost of money has virtually tripled. It's like a 3x cost. And yet the world's most resilient asset class, real estate, is chugging along. And even though the cost of money has tripled, it's still appreciating in value. And here's where all the experts got it wrong. This is their major mistake in why they screwed up and why they were wrong and I was right. And here's why. They looked at the 5 million or so transactions that have occurred since the rates went up. And those people either bought their property with cash or they accepted a much higher rate mortgage. But what they failed to look at is the other 135 million housing units that 42% have no mortgage, that 25% of them are a mortgage at or below 3%, that 65% of those are at a mortgage at or below 4%. They're extremely comfortable. These people aren't selling. In fact, a lot of them want to sell. There's a whole class of people that are empty nester baby boomers that would normally sell. The normal cycle is the kids move out and the baby boomers sell their big house and buy a smaller house. But guess what? They're not selling their house and buying a smaller house because the smaller house would actually cost more money.
That's right. Yeah.
Than the big house. This is a very unusual, dysfunctional market. I've been in the real estate business for decades now. I got my real estate license when I was 19 years old in my first year of college at Long Beach City College in Southern California. And I have never seen this dynamic. It is a very unusual dynamic that we have. And it's going to lead to suppressed inventory for a very long time to come.
Yeah.
So the thing they say, by the way, I have such long answers.
No, you're fine, man. You're good.
Unemployment. Okay. So what I did is I said, look, these people have these incredibly cheap mortgages. So I wonder why don't I get on Zoom with one of my lenders that I've worked with for many years? His name's Joe. And I said, hey, Joe, by the way, he lives in Chicago. Okay. I said, hey, Joe, I want you to pull up your software that you use to underwrite a mortgage. When someone comes to you and says, I want to buy a house, pull up the software and let's underwrite a loan. And I'm going to give you the numbers on a hypothetical buyer. So I said, Jane and John Doe are getting the same income as they would get with unemployment insurance. They have no job. Now, a lender's not going to give you a loan if you don't have a job, but that doesn't matter. All we're doing is looking for what's called the DTI, the debt to income ratio, okay? And you know where I'm going with this. So I said, okay, open up your software and let's assume this couple, they both get laid off, they both lose their job, and they get $2,300 a month unemployment insurance, okay? Which does vary by state, and it varies depending on how much you've made before and paid in. But, I consulted with a whole bunch of people, including my own CPA, and, I did some research, and it seems like that's a reasonable number, about $2,300 a month in unemployment insurance, okay? It's going to vary a little bit, but whatever. And let's assume they've got a car payment, some revolving credit card debt, and maybe a student loan, okay? They've got some debts, and they've got this income. And let's look at the median mortgage payment in the country, right? Which at the low point during the pandemic was $1,001 per month. Now, interesting point about that. 10 years earlier, that mortgage payment was higher. Okay? In 2011, it was higher. It was $1,018 a month when the house was well over $150,000 cheaper. So that's how impactful the cost of money is, right? And then, of course, you adjust for inflation, and literally the mortgage payment during that pandemic era became $290 cheaper, inflation adjusted, than it was 10 years earlier. It's like these people are time travelers. They went back in time. It's amazing. It's amazing. So could they qualify? And the reality is they could qualify. They could qualify on what's called their front end and their back end DTI, or debt to income ratio, meaning their gross income versus their mortgage payment that they already have, and their gross income minus their debts versus their mortgage payment. They can qualify for their loans. So the point here is that these people, even if they became unemployed and lived on unemployment insurance, which lasts for 26 weeks, and during every crisis, they always extend it, right? They'd qualify for their loans. They wouldn't have to dip into savings or anything. They could just make their mortgage payment as if they had a job.
Yeah.
Yeah.
And I'm a lot like you, where I want to look at both sides, right? I mean, I try not to be too romantic about, any investment perspective that I may or may not have. But for me, what I'm seeing, at least on the other side of people that want things to crash, I mean, at the end of the day, there is a lot of, I don't want to say pity, but there is a lot of compassion, right, for that. Because a lot of times those are the individuals that will watch those doom and gloom videos. And, if you kind of look through the comments and you kind of see who's watching, a lot of times they tend to be millennials, younger, or even older Gen Z that's just looking to buy their first home, and they're just having a tough time finding something that's affordable, right? So, I mean, hey, we get it. But, like you, for me, I just want to see the numbers and I just want to see the truth, So shifting gears to 2024, I'm sure you've got a lot of commentary and your perspective on the Fed pivot. Obviously there's a lot of sentiment. Headlines are going on right now about potential rate decreases in 2024. Share with us your perspective, Jason, on what are your thoughts on all of that?
Sure. Yeah. I want to show you an interesting chart. So I have an economist who works for me, who does some of my research projects. And he put this together recently on my request. And so, Daniel, what we've got to look at when we're looking at lower mortgage rates in the future, and all the talk about the Fed pivot, and it's not just in the U.S., this is also true around the world, right? That rates generally are coming down. And I think, we can bet 99% that's going to happen, and the Fed's going to keep their promise to do that, okay? But, we don't know when it'll happen. We don't know by how much it will happen. But we do know that that is the direction, and it's already happened to some extent, that mortgage rates are coming down. So I've talked on my show in the past about mortgage rate sensitivity. And usually I talked about that on what happens if rates go up. How many people would be sensitive to a rate increase and would no longer qualify for a loan if the rates went up. But now I want to talk about what happens if the rates go down, or when they go down, not if, and how many more people could qualify for a loan when that happens. Okay, so here is the answer to that question. If let's just assume the mortgage rate is 7%. Okay, it varies a little bit depending on your loan amount, your qualifications, your geography, the exact time you're watching this, et cetera, right? But we'll use 7% as our baseline. And if mortgage rates go down to 6.5%, that means that 58 million people will now be able to afford a house. And that means we'll have an excess affordability of 2.8 million people. Okay, that's pretty good. Now, that's the potential new buyers, is 2.8 million who could suddenly qualify that cannot qualify at 7%. Rates go down to 6%. And here's, by the way, here's the payment, right? At 7%, just over $2,200 a month. At 6.5, slightly over $2,100 a month. And at 6%, $2,012, right? So it keeps getting cheaper as these rates go down. Now we get into the territory where we've got 5.4 million people who can qualify. And if we get way down to 5.5%, which Ultimately, we'll see, but maybe rates will settle there. That might be wishful thinking. That's why it's in yellow, not green, because I think these two are fairly likely to happen. But this one, not as much, okay? Because that would be an extreme reduction from where we are now, but definitely almost double what we saw during the pandemic era, right? So then we're looking at 7.7 million, right? So let's look at that another way. Okay, this is the additional people that would qualify. Here on this chart are the number of qualifying households at these various payments. Okay, so you can see how that works, right? But what are they coming into, right? What would they be coming into? Well, just going back, let's review. If we just have this slight rate cut to where we get to 6.5, 2.8 million more people can qualify. So what does that mean? We're coming into a market where we ended the year with only 499,000 homes for sale. What's going to happen when 2.8 million people are added to the market? Now, that doesn't mean they'll all buy. They certainly won't. Some won't buy. Okay, maybe a third of them will buy, right? So that's almost 1 million people in a market where we have a massive shortage of inventory. Now, I do want to say something about these statistics, okay? These statistics I'm showing are based only on active listings. There are other sources like the National Association of Realtors who calculate inventory levels differently. Their number will look higher. Why? Because in their housing inventory number, they include pending sales and contingent sales. This is only the truly active listings that you could actually buy today. That's why I like these stats better. I think they're cleaner than the NAR
I would
stats.
agree, yeah.
But it's fine if you use the NAR stats as long as you compare them to the prior NAR stats. So you're always looking apples to apples. So you know that back, in 2019, in the pre-pandemic times, you compare that higher inventory level to today's lower inventory level. Either way, you're going to get the same sort of ratio, but the number will be different, okay? And so what is normal inventory? Well, normal inventory is about 1.2 million. So we have a shortage of 700,000 homes. To just get to normal. Normal is not a bad market. It's not a buyer's market. It's not a crash. It's normal. The vast majority of the last 10 years, we were somewhere in the neighborhood of normal. And I made a heck of a lot of money. I mean, what my company does is we help investors buy properties nationwide. And we actually prefer a more normal market. It's very hard to operate in a market with low inventory. We don't like that type of market as brokers, essentially, right? We run a referral network that helps investors buy these properties. And now, the other thing I want to say is that let's compare this, right? Compared to what is always the right question. So compared to 1 year ago, inventory is down by 10.3%. And compared to 2019, the pre-pandemic era, inventory is down by 49.3%. 700,000 below normal is the inventory. So if we just get to that sort of first cut at 6.5% and 2.8 million more people can qualify, and say only 1/3 of them come into the housing market and think, hey, I want to buy a house, what are they going to do? I mean, that's just going to make the market the way it was during the COVID era, savagely unhealthy, meaning you couldn't buy a house.
Right.
There were multiple offers on every house. Every house was going above full price. It was crazy. It's just a very difficult situation. And here's another flaw in logic that you get a lot, okay? A lot of these folks out there say, well, housing affordability is so bad. It's the worst it's been in 40 years. And that's true. That's absolutely true. But that's only for new entrants into the market. Right. That's not true for 135 million people that already have a house. Their houses are super affordable, okay? So what we've done here is we've expanded the wealth gap, unfortunately. And, look at all of this stuff I'm saying can definitely work for you as an investor. You can make money from this. I've made money from it. I own real estate and I have an asset that is in short supply. Our clients have assets that are in short supply. Good for us. But bad, I think, for society.
Yeah.
I think society is important. And, what's always made the U.S. such a great country is it had a big middle class. And it's just sad to see that for so many years, the middle class has been under attack. There's a great book by Lou Dobbs. I read it like 20 years ago. It's called War on the Middle Class. I'd highly recommend it.
Yeah.
And there are other books on the topic.
Yeah. And it's interesting because, there are so many different solutions that are coming out to this huge problem that we have right now in, economic society, so to speak. I mean, obviously one of those things being tiny homes, but the issue with that is, for so many individuals, like you said, from the average American's perspective, they view their home as their primary number one asset, right? And the issue then becomes is when you start, introducing these tiny homes, I don't know if it's going to share that same perspective to the average American as a long-term asset that they believe is valuable to them, So for you, Jason, obviously you pointed out the big problem that this is causing, that it's causing such a huge wealth gap. In your opinion, is the solution simply just to build more? Is it to simply incentivize these home builders to help them with less regulation, but maybe more tax credits? Is that your thoughts there?
Absolutely, 100%. Yeah, we've got to incentivize the supply side. Remember during the Reagan era, I just had Arthur Laffer on my show, for example. And, he was one of the big proponents. He worked for Ronald Reagan, and he was one of the big proponents of what's called supply side economics, right?
Yeah.
So that's what we have the problem. The problem with the housing market is the supply side. Now, that doesn't mean anybody actually wants to solve the problem. Okay, as much as we're talking about this, and it would seem nice to solve the problem, but there's a lot of entrenched interests who don't want to solve this problem. Okay, there's number one, the NIMBY crowd, right? Nobody wants new homes built near them because that makes the value of their home go down. It creates more supply. There's what I call environmental racism, okay, where, anyone in a given area, as soon as they move into that area and they own a home, they'll try and dedicate open space, right? We got to have lots of dedicated open space, right? And that all sounds good. It's nice to see some trees and some open space. I agree. I love it. But what does that do? It keeps people out. That's what it does. It keeps people out. Okay. And especially it will keep minorities out because they generally don't have as much money. Okay. And so, when I had Thomas Sowell on my show years ago, I invented that term in my discussion with him, environmental racism. So that term was invented on that interview, actually. And, it's just unlikely that we're going to see this problem solved anytime soon. One other solution, though, is that there has always been this stigma in the U.S. and probably around the world against manufactured housing. And, most people, when they think of manufactured housing, they think of a trailer, a double-wide trailer, right? And, that's not what manufactured housing is today. Manufactured housing today, some of it is gorgeous. It's really nice, okay? You can build big homes with manufactured housing where the walls, the electrical, the HVAC is all done in a factory, in a controlled environment where there's a lot less waste, and they ship these parts to the job site, the land, and then they just assemble them really quickly, right? The way we build houses hasn't changed in hundreds of years. I had a guest on my show, Daniel, that made a funny statement. He said, the biggest technological innovation we've had in the construction industry in 150 years is the nail gun.
Yeah.
He's not entirely wrong.
Right.
It's really silly the way we build houses. But guess what? There's another big problem with manufactured housing. Other than the stigma and people accepting it as okay, the lenders and the insurance companies don't like it. The insurance companies won't insure it at the same prices, okay? because they think it'll be like a trailer park, and when a tornado or hurricane comes along, it's going to blow it away, right? Which it's not. The manufactured housing now is much better. And also, the lenders think it'll depreciate in value. They view it like a car, like a trailer, right? Oh, maybe you should register that with a DMV. You know, it's like stupid. We've got to get over this. We've just got to, it's very hard to change these entrenched opinions. Yeah. Manufactured housing would be great for society. And I'm talking nice manufactured housing. Look it up, folks. Do some research. There are some beautiful manufactured homes. And I'm not talking about tiny homes either. By the way, you did mention that. And I think that, I don't know, I haven't done a lot of research on this. Maybe you know better, but it seems to me like the tiny home trend has kind of passed. And one of the reasons I think that has kind of gone out of vogue, and I could be wrong, is that when we had the Zoomtown revolution during the COVID era and everybody started working out of the house, they actually need more space, not less space, okay? Because they have a home office now. I'm in my home office. This room's dedicated to nothing else. Nothing else happens in this room but work, okay? And, people need more space, and especially if there's more than one person living in that household, if they got to be on Zoom meetings, phone calls, they need a separate space that's quiet.
And this work from home thing is not going away anytime soon. It's especially with my generation and Gen Z generation. I mean, even here, our office is at the Kwok Brothers, right? I mean, we have probably about 80% of our employees that work from home at least 2-3 times out of the week, And so, no, I mean, I completely agree with you, Jason. So one of the things I've heard you say recently in a video of yours is this concept called shadow demand. Talk to us a little bit about what that is.
Yeah, sure. So, during the Great Recession, which, now was quite a while ago. That was 16 years ago, depending on how you count when it started, right? But we did hear a new term a lot. And that term, Daniel, was shadow supply. And what they referred to is that there were a lot of people having financial problems during the Great Recession. And they thought these people would go into foreclosure. And as the lenders took the properties back, then they would start to dump these properties onto the market. And that was shadow supply. But what I'd like to talk to you about now is shadow demand, which I think is hugely significant and bodes really well for upward pressure on housing prices, but also housing rents. And what do I mean by shadow demand? Well, how many people out there aren't in the housing market, either for rent or for sale or for, purchase, right? And when are they likely to come into the market, and how will they impact the market? So on the screen, what this is called is the demographic pyramid, okay? And this is the way the United States looks. And so on one side, you've got age. It goes up to a little over 80 years old and starts at 0. And the U.S., compared to many other developed countries, has an extremely healthy demographic pyramid. Why is it healthy? Well, because it's fat, and you want it to be really fat in the middle. Why is that? Because you have a lot of working age people who are earning money, paying taxes, creating value, contributing to the economy, and supporting the older retiring people.
Yeah.
Okay. So we don't have too terribly many people that are old yet, although the U.S. is definitely getting older. They call that the silver tsunami, and it's going to increase as the years go by. But it's not that bad yet compared to all of these working age people in the middle and the fat part of the pyramid. Now, we are going to run into a demographic problem, though, in about 20 years, because we have had a baby bust. And people need to have more kids. So I guess one of the messages I want to leave your viewers and listeners with is have more sex.
That's right.
I figured that will make me real popular.
That's right. Yeah, you don't got to tell me twice, brother. I'm good. Yeah. No, but thank you for sharing that, because to your point, man, it's my wife and I were talking about this the other day. How so many people, even our age, Jason, 29, 30 years old, that are still living with their parents. They're having to get roommates, and a lot of situations where even contributing to the shadow inventory or shadow demand here You have so many people already that are in roommate situations
Yeah.
that are just waiting.
I'm going to show you a
for
couple
things to be
charts
more
that'll blow your
affordable.
mind here in a second.
Yeah,
But
please.
yeah, you're absolutely right. There's no question about it. So this, so here's a mistake a lot of people make. Okay, look, we've been having a baby bust. People aren't getting married. They're not having kids. Not good for society. I like people. I believe people are the resource, and we need more people. The more people we have in the world, the more geniuses we're going to have. The more people we have, the more inventors we're going to have. The more, medical cures. That maybe the person that's going to cure cancer hasn't been born yet, right? We need to have people because people are the resource. They are a natural literally by definition, people are a natural resource. Okay, so what we've got here is when you look at housing, what's more important than how many people are having kids is household formation. And it's not that important how many people are, having kids or being born even in the last 10 years. What's important is how many people were born 25 to 30 years ago. And that's pretty healthy. And those people are coming in their prime household formation years, okay? But we lag this out a little bit, and we get into the 2040s, we are going to have a real problem. So real estate investing will not be forever. It will not be the greatest thing forever, because when we get into the late 2040s, that baby bust is going to start really showing up, and you're going to have less demand unless we bring that in through immigration. Okay, so that's a whole hot political issue. But let me just show you this a little more. So this is this fat part of the pyramid, right? And for people who are 18 to 29 years old, that represents about 45 million Americans. And literally 50% of them are living at home with their parents. That's 22.5 million people. So what happens if 22.5 million people come into the housing market? Well, for the first time in the history of the world, we have houses where they have more bathrooms than people in them. So household size has shrunk because there's way more single people than ever, and there's way more people with just one kid or no kids. The dinks, dual income, no kids, right?
Dual income, no kid, yeah.
Right. So the average is 1.8 adults per household. That's the smallest household size probably in forever, okay? But what does that equal? Well, when you take 22.5 million people and you take 1.8 per household, that's 12.5 million actual houses needed. Remember, right now, we only have 500,000 homes for sale. Now, this doesn't mean all these people are going to come into the market all at once, okay? It will take time. But the fact is, these people will eventually, definitely move out and form a household. We all saw that funny movie years ago called Failure to Launch, right? It's kind of a funny movie. And, it's a rom-com. And so, eventually they will launch and they will move out of their parents' house and they will form a household. And there's a lot of shadow demand coming into the market. Now, a few will peel off every year, and, this number will come into the market and continue to come in the market. But over the course of 10 years, we'll probably see the vast majority of this come into the market. So they will either rent or they will buy. And that will create a lot of demand for both rentals and purchases.
I want to finish off this video with a question for you. So let's say that there's a couple watching this. They're both in their late 20s, early 30s. They haven't bought a home yet. They're, let's say they're engaged, right? Their wedding's coming up in 3 months, and they're having a tough time finding their first home. And given the data and the things that we've talked about in this video, I mean, what is your insight if they're sitting across from you at a dinner table, and they're kind of going, well, Jason, what do we do? What do we do, when we want to buy a home, we want to start our life together, but obviously there's a massive shortage right now in the housing market.
Yeah. My first suggestion might sound kind of strange, but it's don't buy a home. And here's what I mean by that. Look, income property is the most historically proven asset class in the entire world, It's the most tax-favored asset class in America. Buy a property, but it doesn't need to be your own home, okay? As long as you're in the game, you're going to be building wealth through property, okay? So buy a rental property maybe. Look, when I was 20 years old, I bought my first property while living at home with my mom, okay? I had a rental property before I had my own house. 2 years later, I bought a condo in Irvine, California, okay? But when I was 20, I was a landlord, okay? And so you want to be in the game. It is the best asset, but you don't have to own the house in which you live. There's a couple things here you really want to think about. Okay, number one, jobs. When you're a young person, one of the best things you can have on a resume is mobility. Being able to move to where the opportunities are, being able to move to where the jobs are, not being bogged down by, oh, I got to sell a house before I move. And, with the closing cost and all that stuff, it may be too high. So that's another thing, mobility. It gives you a lighter, more mobile life. Okay, you could even be a digital nomad and go, travel around the world if you want, right? Do remote year or one of those other programs or something like that, but own a property, okay? Own a property, okay? The other thing is, if it's not a house in which you live, you're not that picky about it, right? It doesn't care. You don't care if it's in the right location or if it's a cute house with nice curb appeal. You just want the numbers to work as an investor, right? And so you really take a big burden off your shoulders by not worrying about buying a house for yourself. Just get a house that you can rent to somebody so you're in the game. Okay, you're going to have better characteristics than owning your own house because someone else is paying the mortgage for you, right? And you just do whatever you want, do whatever makes sense. If you live in Philadelphia now and you decide, hey, I want to, get into the tech world or the internet marketing world, and I got a bunch of friends that live in Austin, Texas. That's where my connections are. You can go move to Austin, rent an apartment, rent a house, okay? And maybe you own a property in Florida, okay? Or Alabama or Tennessee. Then you're detached from it. So just buy a property. Doesn't need to be an owner-occupied property.
Yeah, and I would 100% agree, right? I mean, one of the things that I'm telling a lot of my peers that are my age is, hey, there's this great thing called house hacking, where it's like you buy a multifamily unit building, a 4-unit, a 3-unit, or a 2-unit, and you live in one unit and you rent out the other, but you're buying the whole property, right? So, I think that's a tremendous option. Jason, thank you so much for your time, for being here, and really appreciate your insights.
Yeah, my pleasure, Daniel. Happy investing to everybody. And, feel free to check out my YouTube or my podcast. Just look up Jason Hartman or my main website, jasonhartman.com.
Yeah, thank you so much, Jason.